Adam Sweet. I lead our pass-through entity group, pass-through entity consulting group at Eide Bailly. I sit in Spokane, but I'm part of our national tax office. I'm joined by Max Stevens, who is also part of our national tax office. He sits in Billings. And then Todd Laney, again, part of our national tax office, and Todd sits in Boise. But first, just wanted to thank everyone for joining us today. So the agenda for today, just keeping it nice and simple here, was discuss these new 199A regulations that came out a few weeks ago. And really, it's a couple hundred pages of regulations, so we could spend all day walking through every page of them. But really, we think that it's more important to talk about proposed regulations came out in August, and what are the differences between these final regulations and the proposed regulations. Now, it's important to note that there's also additional guidance that came out at the same time when these final regulations came out. First of all, we have additional proposed rules for what to do if you have suspended losses, if you didn't have enough basis, or if your losses were suspended because of the at-risk rules or the passive activity rules. There's a regulatory package that came out that gave certain ordering rules for how you take those into account for 199A purposes. We won't be talking about those today. And then there are also rules for RICs, regulated investment companies. What happens if they receive a REIT dividend and that's passed through? How is that treated? Again, we won't be covering that today. Those are important regulatory packages, and so I'd encourage you, if these will affect you, to seek out those regulatory packages, and also stay tuned that we will have additional guidance in the future, either in the form of a webinar or in the form of an insight that will touch upon these topics. So just to set the stage for 199A, those of us that practice in this area, I think we can almost recite some of this stuff in our sleep, but we forget that many other people have other things that they do out there besides practice tax. So just to set the stage, 199A provides a 20% deduction on qualified business income, QBI. So a couple of important things. First of all, not all income necessarily produces the 20% deduction. You need to have QBI, and not all business income is necessarily qualified business income. So you might say, well, what's the point of 199A? Well, the point in general terms was to equalize the treatment of pass-through businesses. Those are sole proprietorships, S corporations, partnerships, any business where the owner of the entity pays the tax, that there's no entity level tax. Think you get a K-1 and you pay tax based on your share of the business income. Is to equalize those businesses with C corporations, because C corporations, the corporate rate was dropped from a high of 35% to a flat 21% for all C corporations, large and small. So Apple, Amazon, right down to the small C corporation in Spokane, all pay tax at a 21% rate. 199A is supposed to be the equalizer there, because without it, then potentially everyone's going to want to be a C corporation, because the rate differential would be a lot greater in C corporation form. So also, though, trusts and estates are also eligible for 199A, even though we typically think of it as being a pass-through entity deduction. It is, but trusts and estates are also eligible for 199A. The ultimate deduction, even though QBI comes from a business, the actual deduction, the 20% deduction, is computed at the individual level, not at the business level. So all relevant information is reported from a business to the owners. In the case of an S corporation or a partnership, it's reported on the K-1, and you give all this information out, and then the owner takes that information, inputs it onto their 1040, and working with their tax advisor, comes up with what the deduction amount is. What it does, in effect, is drop the federal rate that you pay on the tax you pay on the QBI. And if you're in the highest marginal tax bracket, which is now 37%, if you would normally pay 37% on that QBI, if 199A applies, it drops your rate down to 29.6%. So almost an 8% rate cut if 199A applies. Now, just as importantly as all this is that, like everything that Congress does, it sounds simple on its surface, and then you dive into the details, and there's layers and layers of complexity. And a lot of that complexity is that the 199A deduction, even if you have qualified business income, it is not an unlimited deduction, meaning it's not as simple as just taking QBI, taking 20% of QBI and being done. There's numerous limitations that are taken into account, both limitations related to items from a business and then also limitations taken into account at the individual taxpayer level. Now, some of these limitations are you need W-2 wages, you need enough basis in property. At the individual level, there's a taxable income limit. We're not going to cover those today. It's beyond the scope of this webinar, but just remember that it's not unlimited, and there are lots of important limitations to consider. So final regulations were released on January 18th, 2019, so almost a month ago. A couple of highlights here. Typically when final regulations come out, they supersede any proposed regulations, meaning that the final regulations are all that anyone can rely upon. Because the final regulations came out late, and it came out, in fact, in 2019, the IRS said, well, for the 2018 tax year, and only the 2018 tax year, taxpayers can rely upon either the proposed regulations, and the proposed regulations were issued in August of 18, or taxpayers can rely upon the final regulations that were released just a month ago. For 2019 forward, proposed regulations go away, and we're stuck with relying upon the final regulations. So given that you can rely upon either the proposed regulations or the final regulations, it's particularly important this year to understand how are those regulatory packages the same and how are they different. And you'll see in the presentation today that there are some material differences, and certain taxpayers may be better off for the 2018 tax year relying upon the proposed regulations rather than relying upon the final regulations. But one important point along with that is you can't cherry pick certain portions of the proposed regulations and then other portions of the final regulations. What the IRS said was you can rely upon one or the other, but you have to rely upon them in their entirety. So you're either filing your tax return entirely based on the proposed regulations, or you're filing your tax return entirely based on the final regulations. So the big item, maybe the biggest item that the 199A, the final regulations addressed, was the treatment of rental income. For many businesses, non-rental businesses, so if we have business owners on this webinar, likely it's a know it, I call it a know it when you see it determination of whether your income is QBI. And taking a step back, qualified business income, when the proposed regulations were released in August, the IRS said qualifies business income as income from quote unquote a trader business. And I just think for most of our clients and most of the people that we work with, you just know it when you see it. If it's a construction company, if it is a retail company, if it's a manufacturing company, it's been a trader business forever. It's still a trader business under 199A. It produces QBI. Doesn't necessarily mean you're going to get the full 20% deduction because there could be other limitations to consider, but the baseline question of whether it produces QBI, it's not going to take much time to reach a conclusion on that. The big exception is rental income. Quote unquote, what does it mean to have a rental trader business? The proposed regulations did not give us any additional guidance for this. All the proposed regulations said is look to existing guidance that's been on the books for about the last 60, 70 years to figure out whether rental income stems from a trader business. So the important point here is if it doesn't come from quote unquote a trader business, it's not QBI, and you're not eligible for the 20% deduction. We're just done, right out of the gate, we're done. So fair enough. So the IRS says you look to the existing guidance. Well, if you Google, in your spare time, Google rental trader business, you're going to read 20 articles in a row that point out all of the inconsistencies out there in terms of the guidance about what it means to have a rental trader business. And it's frankly just not clear. And oftentimes the guidance, you might find a court case from the Ninth Circuit that says X, and you might find a court case from the Fifth Circuit Court of Appeals that says Y, and oftentimes they seem contradictory. And then you could layer in on top of it, there may be some letter rulings or revenue rulings from the IRS over the last 30, 40 years that are also contradictory. So it was a mess. Anyone that had a material amount of rental income and is trying to figure out for the 2018 tax year forward, is this income that I put as rental income on the K1 from the rental of my commercial building or my residential homes, is this going to be QBI? It was a mess because no one knows, and the proposed regulations didn't really tell us anything else. So that was a lot of the commentary on when these proposed regulations are released. There's lots of comment letters sent to the IRS, either critiquing portions of these proposed regulations or asking for additional guidance. Probably one of the most popular topics that people asked for additional guidance for was in regards to rental income. So if we look at the proposed regulations and even under the final regulations, and we say, well, what does it mean to have a rental trade or business? I think unfortunately, what it really, or fortunately, depending on your outlook, what it comes down to is really a facts and circumstances analysis, meaning that there is no objective standard. Each set of facts stands on its own. And so undoubtedly scale plays a factor in that, meaning the more rental activities you have as part of a trade or business, or as part of an activity, maybe the more it looks like a trade or business. Time spent either by the owners or contractors or employees, commercial versus residential, commercial may look more like a trade or business, depending on who you ask. Books and records, how formal are the books and records? It looks more like a trade or business. And there's undoubtedly many other factors. So, it's interesting because you look at this, and I put this question to Mac, that it would seem to be different taxpayers could reasonably reach different conclusions if they have a rental activity on whether that rises to the trade or business. So I'd be interested, Mac, whether you agree with that, or what are your thoughts on that?
Well, absolutely. And certainly, as you pointed out, Adam, there's no concrete guidance on when a rental real estate activity rises to that level of a trade or business. And that's the threshold for being able to claim the deduction. It's subjective analysis, and I agree with you. I think reasonable people, whether maybe it's you or me, but taxpayers and their advisors can reach different conclusions, based not only on whatever their particular facts are, but also each taxpayer's appetite for taking risk in a tax return. I'm always kind of reminded of the old Wells Fargo stories of the trick question they used when hiring stagecoach drivers. And it was basically, how close to the cliff do you like to drive your stagecoach? And some of us like to have the rim of the wheel just over the edge of the cliff, and others don't want to go anywhere near it. And then the analysis, I think, gets even more confusing because some of the rules we're used to, and I'm especially thinking of like the passive activity loss rules that we lived with for 30 some years, have similar but not exact rules. So on one hand, the 20% deductions available to passive as well as active owners. So meeting a material participation requirement really isn't that important. But then on the other hand, we'll see situations as we go on in this webcast where a self-rental arrangement under the passive loss rules, which can be very advantageous, won't qualify as a self-rental under Section 199A. And then the Section 199 aggregation rules that we'll talk about in a little bit are more strict than the grouping rules we're used to under passive activity. So there's potential for a lot of confusion in all this, I'm afraid.
So do you think, traditionally the tax practitioners, when we think real estate, I mean, as you mentioned, we think Section 469, the passive activity rules, and if you have an owner of a business, an owner of a real estate business that doesn't materially participate, maybe all they do is invest money and they collect a check. We traditionally think, oh, we're going to automatically need to segregate that activity, the income and losses. We can't mix together with other active income. So is it likely, or is it likely that many taxpayers may be passive for 469 purposes, but still be eligible for the 199A deduction?
Well, I think we'll see, but I think that's largely the case because that, in my view anyway, because we go back to the threshold of a trade or business. So I think that very well could happen, Adam. Don't you?
I would 100% agree. If you think about it, that the calling something QBI is an entity level determination, and once you call it QBI, so if it's a rental activity that rises to the level of a trade or business, if you've made that determination, then it's QBI for every partner. And that may be some partners may be active and some partners may be passive. So the income and loss may be treated differently for 469 purposes, but for 199A QBI purposes, generally speaking, it should be uniform treatment across the board for those different owners. You know, again, the ultimate deduction may vary depending on various limitations, but it's either QBI for everyone or it's not QBI for everyone. So it's a different mindset than what we traditionally think about when we think about real estate in 469. So the big thing the IRS did with the final regulations, they didn't provide new facts and circumstances to consider necessarily. They didn't give us necessarily a whole bunch more to work with, but one thing they did give us is what's called it's a safe harbor. They issued a notice 2019-7. All an IRS notice is the IRS is saying that they intend to issue typically a revenue ruling or a rev proc. In this case, it's a rev proc, a revenue procedure. And this revenue procedure will provide a safe harbor that will allow a quote unquote rental real estate enterprise to be treated as a trader business for 199A purposes if certain requirements are met. So a couple of baseline things here. First of all, real estate enterprise, it's defined as an interest in real property held for the production of rents and may consist of an interest in multiple properties. And so and also a relevant pass-through entity, which for 199A purposes is an S corporation or a partnership, they can conduct quote unquote a real estate enterprise under this proposed rev proc. So all it's really saying is if you're an individual, if you're a partnership, if you're an S corporation, and you have a real estate enterprise, so you own some property or own some buildings and you're renting it out, if you meet the requirements of the safe harbor, you can be in the warm waters of the safe harbor and treat it as QBI. And in fact, you might even be able to tell your investors or the members of your LLC that we meet the requirements of the safe harbor. And that's going to give you a lot of comfort because strictly speaking, if you meet all of the requirements, the IRS won't challenge your treatment. But the devil's a bit in the details because you'll see in a second that there's some stringent requirements to meet the safe harbor. And no doubt many taxpayers may not meet the strict four corners of this safe harbor. A couple other things, if you commercial and residential real estate are not considered to be part of the same enterprise. So if you have an LLC and you own a commercial office building and then you own a residential home, the IRS says for purposes of the safe harbor and for purposes of the proposed revenue procedure, that is not one enterprise. So you'd almost have to treat that as two separate enterprises and test each of those on their own to see if they meet the requirements of the safe harbor. And if they don't, if one did and one didn't, then presumably the one that met the safe harbor requirement, you could call QBI and say that you met the safe harbor. If for the other one that you didn't, it'd be back to kind of a facts and circumstances analysis. Big important point though, and we can't emphasize this enough, just because you don't meet the safe harbor requirements, which we're going to jump into in a second, that doesn't really necessarily mean anything. We have lots of people calling us saying, I can't call my rental activity, I can't call it a trader business, and I can't say that there's QBI. And I say, well, why? They say, well, we don't meet the safe harbor requirements. That isn't the case. If you don't meet the safe harbor requirements, all that means is just that you didn't meet the safe harbor requirements, that there's no other judgment taken from that. In fact, the IRS explicitly says that in this notice, that no doubt many rental businesses will still be classified as trades or businesses and produce QBI, even though they don't meet the safe harbor requirements. So very important point there. And then one other very important point is, and this was kind of snuck into the notice, that if you're treating your rental real estate enterprise, if you're calling it a trader business and you're saying that it produces QBI, so if your LLC owns a commercial office building and the K-1s you issue to the members, you say this is QBI, the IRS says that you must treat, the IRS says it expects to see that business treated as quote unquote a trader business for all other purposes of the code. So this would mean, for instance, that the Form 1099 filing requirements, that if you're paying third parties or management companies over a certain amount of money every year, there's, in a normal trader business and just an operating business, you're having to file an information form with the IRS reporting that payment so that the IRS can track it. My understanding is that oftentimes rental trades or businesses may not be filing these forms 1099. I think the IRS knows this. And so what the IRS said is, be consistent. If you're going to tell us that you have a rental trade or business and you're going to tell us that it produces QBI that's eligible for the 199A deduction, the IRS says, treat it then just like a normal operating business and issue all of the requisite payor or payee forms that you would issue if it was an operating business. So something to pay attention there, that it could be an avenue. The IRS starts to conduct some examinations. This could be one of those threshold questions where if it examines an LLC and it says, the IRS says, well, you've called your income QBI, have you issued all of your required Form 1099? Hopefully the answer is yes, to show that you've been consistent. So there's 3 general requirements to meet for purposes of this safe harbor. And maybe Todd, if you could walk us through the first couple of these requirements.
Yeah, for sure. So the first requirement is having 250 hours of qualifying services. These are going to be performed during the taxable year with respect to each enterprise. Now, after December 31st, 2022, this requirement can be met in any 3 out of the 5 tax years. But these services, they can be performed by a variety of individuals. They can be performed by the owners of the rental enterprise, by their employees, or independent contractors. Some examples of the qualifying services include performing maintenance on the properties or on the rentals themselves, performing rents, repairs, collecting rents, payment of expenses, or providing services to the tenants, any efforts to rent the property as well. There are some examples that were stated in the final regs, though, of non-qualifying services. And these include arranging financing, procuring properties, reviewing financial statements or reports, making plans, managing, or even contracting long-term capital improvements, and then even traveling to and from the real estate property. And also within this requirement, it is required to keep records of the services of these hours, to provide documentation to the service that this requirement was met.
So one important point too here, if you look, as Todd mentioned there, that this 250-hour requirement, and this just emphasizes the difference between 199A and the 469 passive activity rules. It does not need to be owner time. So this could be employees, this could even be paying independent contractors, potentially property management companies. All of that time can count towards this 250-hour requirement. So big difference between, 469, the focus is on really the person receiving the income, the owner, what is their activity? Are they materially participating? Here, it can just be anyone's time. And then what about?
And one other thing to note is, for the 2018 tax year, the contemporary record keeping is waived for the 2018 tax year, but any other year after that, you would need to document these hours of qualifying services.
That's right, and that's a nice taxpayer-friendly answer there, because the IRS is promulgating this rule in 2019. It would be unfair if people have not been tracking this, maintaining the contemporaneous records of the time spent. It's hard to go back to 2018 and recreate that, so taxpayers get a pass for 18, but for 2019 forward, hopefully following that requirement.
Right. And then the second requirement within the safe harbor is just maintaining separate books and records and even separate bank accounts for each real estate enterprise.
And any idea, Todd, what does that mean? Could it mean different things to different people? What are books and records necessarily?
Yeah, for sure. It could mean different things for different people. As you were talking about the different enterprises, this could be maybe just one rental property that has a separate books and records for it and a separate bank account. If it's maybe just a personal rental property that may or may not meet some of the other requirements, or it could be a greater rental real estate enterprise that is full of commercial real estate properties that has more in-depth books and records and bank accounts to cover that real estate enterprise.
Thanks, Todd. And then the third requirement, so we know we need 250 hours of time. We know we need contemporaneous records. The third requirement, maybe that will prove to be the most onerous depending on circumstances, the IRS said triple net leases do not qualify. Flat out don't qualify under the safe harbor. So if you have a triple net lease, no matter how much time you're spending, no matter your books and records, you don't qualify under the safe harbor. So for purposes of 199A and for purposes of the notice, the IRS said a triple net lease is a lease agreement that requires the tenant to pay all or a portion of the taxes, fees, and insurance, and be responsible for all or a portion of the maintenance activities, in addition to rent and utilities. This is problematic because this is a very common business practice, the triple net lease, where these responsibilities are on the tenant and not the landlord. So I put this question to Mac, can you conceive of a situation if, we started off by saying, and even the IRS said in the notice, just because you fall outside of the safe harbor for whatever reason, doesn't mean necessarily you don't have a trade or business. So specific to here, if can you conceive of a situation where a client has triple net leases, doesn't qualify under the safe harbor, but still may have qualified business income?
Yeah, a good question, Adam, but I sure think so. I guess we'll find out as taxpayers get audited in coming years, but it sure seems possible. Excuse me. To use an extreme example, say someone leases out half the commercial buildings in Lower Manhattan on triple net leases. I mean, the sheer volume of the properties would be very convincing that the owner has a trade or business. But what about 5 properties or 10 properties or even 50 properties? I think we need to analyze all the facts that we've talked about, reach a conclusion on trade or business. But for sure, all isn't lost solely because someone owns rental property that's subject to triple net leases. Of course, in some cases, it may make sense to maybe renegotiate leases, right?
Absolutely, if it's commercially feasible. I mean, I think maybe the smaller the operation, that may be possible, and I think no doubt, the larger the operation, if you have a long-term lease, it may not be feasible for some people to knock on the tenant's door necessarily and renegotiate. But if it's possible, if you can knock out one of those legs of the, either take responsibility for maintenance or taxes or insurance, technically, by the 4 corners of the notice, you don't have a triple net lease, so maybe you feel better about either being under the safe harbor or just calling the income QBI.
Yep.
So just want to keep emphasizing this point. I know I've said it a few times, but just because you're outside the safe harbor doesn't mean really necessarily anything. And so I guess I'd put it to you again, Mac. I mean, if you have a client that calls you, or if there's an Eide Bailly partner that calls you with a client situation, and the client or the Eide Bailly partner is concerned because they say, hey, Mac, we don't meet the safe harbor requirements. We don't have the time, or we have a triple net lease, or we don't have the books and records. What are you thinking when you get that call?
Yeah, I mean, I think obviously the safe harbor would be nice to have, but the value, as you pointed out, is limited. So frankly, I'd look to the safe harbor and say, well, maybe the benefit it provides is to show us the factors we need to focus on. And like we've talked about, just digging back into the facts and building a case for trade or business treatment, and things like types of property, numbers of properties, owners, agents, day-to-day involvement. Even if it falls short of the safe harbor, it still can be significant. Types of services provided by the landlord, you know, and Todd went through the qualifying and the non-qualifying services. Well, even the non-qualifying services, if we don't meet the safe harbor, I think those are still important things to consider as far as building a case for a trader business. You know, the things like reviewing financial reports, construction and traveling, and making capital improvements and so forth. So then arranging financing. Terms of the leases like we've talked about, and generally just making the rental look like a trader business, as you pointed out, Adam, with filing forms 1099 and keeping those separate books, records, and bank accounts. So I think those are the things I'd really focus on.
Yeah, and do you think, I mean, I've thought about this, but do you think even maybe the other usefulness of the safe harbor is if you don't meet it, I mean, do you think that it maybe is providing some things that the IRS would look to specifically, you know, in the event of an audit, or maybe with future guidance that they're providing us in a way, maybe they're also trying to be helpful with listing some things the IRS could look at, even for being outside the safe harbor?
Yeah, well, no, I agree, and that's to me, it's sort of the laundry list of things, to the all sorts of factors, but ones that would be priorities and what we'd be trying to look at and build a case for trader business.
So it's interesting with, and this is not unique to 199A. I think this is for lots of different portions of tax reform, that form matters. Your form, that economically you could have a very similar arrangement, and because you structure it, the structure of the form is different, the legal form is different, or the tax form is different, that you reach two different conclusions. And it can be frustrating for clients because clients say, economically, what's the difference? There is no really economic difference, but because there's a different form than maybe the form that the IRS looks to in its guidance, that maybe you reach a different answer. So I think this is one example here, and I'll just kind of introduce the basic facts and then ask Mac to kind of explore it. But basically, you have the common set of factors, or the landlord pays for maintenance. In these two examples, you have a real estate enterprise. Assume you have the 250 hours of qualifying service. You maintain the proper books and records. Basically, we're trying to set it up that you're meeting potentially the requirements of the safe harbor, the rental safe harbor, if you view this as one business in the aggregate. And the difference between these two things are, in example one, so the common fact pattern is you have 3 buildings, but in example one, each of the buildings is owned in a separate partnership. And then in example 2, there's one partnership that owns each of those 3 buildings. And Mac, I guess, you know, under the safe harbor, do you think you reach a different conclusion for example 1 versus example 2, even though economically it's almost exactly the same?
I sure think so. Each partnership in example 1 would be treated as its own rental real estate enterprise for purposes of the safe harbor. So it's likely that none of them would qualify for the safe harbor, and frankly, may even have trouble on their own rising to the level of a trader business. But looking at example 2, interposing a partnership to hold the interests in the 3 properties, sort of a holding company approach. I think we now have one enterprise, and there's a better chance of meeting the safe harbor tests, and if not meeting those tests, at least establishing that we've got a trader business, I think. So that's how I would view this.
Yeah, I absolutely agree. And again, if you're out in the audience and you're saying, well, what the heck is the difference between the two of those? I think we 100% agree with you, but we're also stuck with the guidance that we have from the IRS, and for whatever reason, the guidance favors maybe the form under example 2 and less so under example 1. So if you have example 1, maybe there's some restructuring opportunities to become example 2, and suddenly now you're within the safe harbor and you can have more confidence in calling the rental income QBI. The one other big thing with rental income, we had just a question on CPE questions. They are coming. I think we backloaded our CPE questions, so they'll be coming shortly. So the one other thing about rental income, and this is one of my first questions I ask when people call me, is that the proposed regulations provided a self-rental rule, and the final regulations stuck with this rule. And what this just says is if you have common ownership between an operating company and a real estate company, sometimes call it OpCo and PropCo, common ownership is 50% or more using the related party rules. The rental income, to the extent that the real estate's provided to the operating company, the rental income is automatically going to be designated QBI, no matter the economics of the real estate entity. So even if you have a triple net lease, even if you just have a single commercial building, the IRS said they're going to treat that rental income as 199A income, QBI income. In a way, really, they're just putting the operating business's income together with the rental income and just saying this is just one trader business, which makes sense given the common control and also given that the real estate is used in operations. So taxpayer-friendly rule, something not to forget about. It covers more than a few of our clients who are, call me, worried about whether they have rental income. And then once I dig a little deeper into the facts, I realize that we can rely upon this example. But it also produces some interesting results. And this is a little more complication to this fact pattern here. Again, we have real estate entity operations. Husband and wife own 100% of operations. Their kids, who are brother and sister, own 90% of the real estate entity, and then a third party owns 10% of the real estate entity. So we have common control because we have 50% or greater ownership of the real estate entity and the operations using the rules of attribution. So brother and sister's ownership is attributed to the husband and wife is attributed to the brother and sister. We have that there. The real estate is exclusively used by the operating company, so we satisfy that factor there. So then I guess I'd put the question to Mac, what about this unrelated third party who's going to get a K1 for the third party's 10% share in the real estate entity? Do you think that there's a position to take that that income would be QBI, even though the third party doesn't have any ownership in the operations?
And I sure do. I think that's what we're told under the final regulations, Adam.
Yeah, it's an interesting quirk that you wouldn't necessarily expect it, because again, I think our brains are so programmed to the 469 rules where we're focused on owner activity, and to the extent that the owners are involved in operations, it would make sense that if they're involved in the real estate entity, we put that together. But it's an interesting quirk here that it seems to say, any kind of minority partner in the real estate entity would have QBI on their K1. Brings us to our first polling question. True or false? So real estate enterprise, this is under the safe harbor, is defined as an interest in real property held for the production of rents that may consist of an interest in multiple properties. True or false? Excellent. So it looks like almost everyone was paying attention. That is indeed true. So switching gears a little bit, I see we have some questions too. Hopefully we'll have time at the end to answer some of the questions. If we don't, then we will stick around post-webinar if people have time, and we can deal with those questions. But one of the other big issues that we've been looking at for the 199A deduction is, what does it mean to have a separate trader business for 199A purposes? And it matters because the 199A deduction is not necessarily entity specific. It's business specific. So the deduction is first computed on a trader business by trader business basis, meaning you compute QBI on a trader business level, you compute the W-2 wages on the trader business level, and then you flow that information up. So a single entity can have multiple trades or businesses. So what does it mean then? How do you figure out if you have one entity? How do you know if you have multiple trades or businesses or single entity? Because in the past, you've probably just reported it as just box one income and just reported it out to the owners, and that was all you needed to do. So the final regulations tell us to look to, piggybacking off of existing guidance, they say look to the existing guidance under Section 446, which governs whether something can have a separate method of accounting. And they say, well, if you could have a separate method of accounting under Section 446, then we will consider you a separate trader business for 199A purposes. So what are the factors under 446? If you have a complete, and the IRS uses the word separable books and records, separable is highlighted or bolded because it doesn't necessarily mean it needs to be separate. Separable seems to suggest capable of being separated. So maybe you have a single set of books and records, but if they're capable of being separated, maybe that satisfies that requirement. Having dedicated employees, geography may come into play, and no doubt there's many other factors that could come into play. And you may be wondering, why does this matter? Why would you care about one trade or business or multiple trades or businesses? A couple of reasons. One would be, we're going to cover this in a second, but as I mentioned in the beginning, not all business income is QBI. And one of the big exceptions is if you have what's called a specified service trader business. If you have income from a SSTB, that income does not qualify. And there's a very harsh rule that was in the proposed regulations and affirmed in the final regulations that says if you have more than a de minimis amount of service revenue, just qualified service revenue, it taints everything. And if you have gross receipts of 25 million or less, 10% or more of your revenues from service, it taints everything. So if you have gross receipts of 25 million and 11% of your revenue comes from disqualified services, it taints the other 89%, and 100% of your income is treated as non-QBI. This rule is ratcheted down to 5% if your gross receipts are over 25 million. It's the cliff effect because you can come right up to the edge of the cliff, and then once you take a step over, you're at the bottom of the cliff and you don't have QBI. So the planning opportunity would be really, if you're confronted by this, if 15% of your revenue comes from a bad business, quote unquote, can you argue it's a separate trader business? And this example here is simplified, but shows that the S Corp has 3 different businesses. It's a service business, and then business number 1 and business number 2. And we're assuming business number 1 and business number 2 produce QBI. If we treated this all as just one single business, the service business could taint everything and result in no 199A deduction. So the planning opportunity would be structuring it or arguing that the service business stands on its own. It doesn't produce QBI, that's fine, but QBI business number 1 and QBI business number 2 can still produce the deduction. How would you do that? Well, the same factors we were talking about. Hopefully you're separately tracking expenses and income, books and records. If you can use single member LLCs, the IRS has said in the past that may help, but really it comes down to, like many portions of 199A, of facts and circumstances analysis. And we're going to talk about this in a second, but one thing to pay attention to here is the quote unquote crack and pack rules, that if the service business is really not separable from the QBI business, if the service business is providing its services to if the segregated businesses are providing their products and services directly back to the service business rather than the third parties, there's an IRS anti-abuse rule that could bring all of that together again and call it SSTB. Aggregation, maybe you can run us through quickly, Todd, just what is aggregation and why you might do it for 199A purposes?
For sure. Yeah, so aggregation, it is essentially combining multiple trader businesses and reporting them as one trader business. And there's some small differences between the proposed regs and the final regs. On the proposed regs, aggregation was only allowed at the individual level. But now with the final regs, aggregation can take place at the business level or at your partnership, your S Corp return, or at the individual level. Now, there are some requirements to be able to combine businesses and aggregate them. One of those, they have to be under common control. They also have to be within the same taxable year. None of these trader businesses can be a specified service trader business. Those may not be aggregated with other trades or businesses. And then lastly, 2 of the following 3 factors need to be met to be able to aggregate. That is complementary products, similar products, property and services. Property is an addition from the final regulation. They need to have shared resources, be it maybe accounting or human resources, something like that, or interdependencies between the two businesses. Maybe they're part of the same supply chain. There is also a duty, though, once you make an aggregation election, once you're aggregating certain trades or businesses, you need to continue to aggregate those over the years. and the election is made, the disclosure must be made on the relevant tax return. The IRS wants you to list the trader businesses, their EINs, so they can track. And this is at both levels. So if you're aggregating at the individual level or the partnership level, that disclosure is the same. So here's just one example. So ABC, they are the partners, and let's just assume that the aggregation requirements are all met. So aggregation on the final regs can happen at the partnership level or at the individual level, meaning that the partnership is going to aggregate these three businesses, report them as one, or maybe the partnership's not going to do that, but partner A wants to and partner B does not, and that can happen. There are some reasons to aggregate. It could maximize the 199A deduction. In this example, let's just say that business one has high QBI, but for whatever reason does not have wages or UBIA, and the partners need those factors to be able to take the deduction. But QBI business number two, for whatever reason, it does not have high QBI. It has very low QBI numbers, but it houses the bulk of the wages. Those businesses could be aggregated so that those wages could benefit business one and business two and maximize the deduction. Like Adam said, 199A, it is a calculation on each trader business unless those businesses are then aggregated. And so that those other businesses that may not have those factors won't be able to utilize them unless they're aggregated with other businesses. And that includes, wages and the UBIA. And then just one last reminder: those SSTBs, those cannot be aggregated. So even though you might be below that income threshold and you've got a specified service trader business, those cannot be aggregated.
Thanks.
I think that goes to our next polling question. Another true or false. There is a duty of consistency once an aggregation election is made, and the disclosure must be made on the relevant tax return. Is this true or false?
True it is. Specified service trades or businesses, again, we mentioned in the beginning, I mentioned this when discussing the cliff effect, but not all trades or businesses necessarily produce QBI, and the statute defines certain types of businesses that don't produce QBI, and a lot of them are ones, doctors, lawyers, accountants, consultants, athletes, people involved in the financial service sector. For whatever reason, Congress carved those professions out and said you are not eligible for 199A. A couple of things, though, to always remember when we get these questions, and Todd mentioned this in the last slide, even if you have an SSTB, one thing to think about is SSTB can produce, this is kind of the exception within the exception. If you think about SSTBs as being the exception to the 199A deduction, the exception to the exception is if you're a taxpayer with taxable income below certain income threshold amounts, and for 18, it's $315,000 for married filing joint, $157,500 for single filers. This is taxable income, not gross income. So after all your deductions, you still may be eligible for the 199A deduction, even if you're getting a K-1 from a law firm for law services. But the final regs layered in some additional guidance on what it means to be performing a specified service trade or business. And one thing they did was perhaps taxpayer unfriendly. They're proposed in defining health services, so this is doctors, nurses, and so forth. The proposed regulations had talked about direct services, direct patient services, and the final regulations remove this and use the word, remove the word direct. And so I guess my question to Mac would be, where does this stand? Do you view this as narrowing the field or expanding the field of services that could be considered health services and SSTBs?
Yeah, I think it definitely, Adam, narrows the field a little bit. The preamble, excuse me, to the final regulations mentioned a radiologist as an example and said, well, I think we'd size it up and say, well, normally a radiologist isn't dealing directly with patients. And so under the proposed regulations, arguably the radiologist wouldn't be performing services in the field of health. But under the final regulations, because of the that direct connection eliminated, I think it's clear that the radiologist would generally be viewed as performing bad health services from a QBI standpoint.
Yeah, and they also, the other thing that these final regulations did was there were a lot of questions that came in about businesses that maybe are involved in the healthcare industry, and perhaps these businesses don't view themselves as providing direct medical care. So the businesses said, hey, IRS, you should give us a friendly rule that tells us that the income from our business, even though we operate in relation to the healthcare industry, that our income is good. And one example was retail pharmacists, and I've heard it described as pill counters, or that to the extent that it's all someone is doing is filling a prescription with counting pills and putting them into a bottle and giving it to a patient. Does that qualify? Is that an SSTV, and is that bad income? And the IRS had indicated under the right set of facts, indeed, a retail pharmacist may not be involved in the performance of services in the field of health, meaning a retail pharmacist, again, given the right circumstances, potentially could have QBI. Another interesting example, and there are two of them we're going to cover here. One involves nursing homes, and the other involves surgical centers. And maybe Mac, if you could run us through the nursing home example quickly.
Yeah, I think this is a good example for anybody involved in that industry to take a close look at. It involves a residential facility, could be nursing home, assisted living, retirement community, or some combination. And the facts are key, and you want to look at those on this slide. Basically, that there's standard domestic services that are provided. And then the facility engages with local healthcare organizations to provide medical care, health services, and then those separate organizations bill the residents, not the facility. And then the facility gets all of its income as part of the factual background of the example, solely related to residing at the facility. We can go to the next slide. But the strict facts beg some questions around, well, what if the facility has nurses on staff? Maybe even to satisfy a state law requirement. Does that mean the facility can't rely on this example? And I think that's a risk. Could having nurses on staff cause the entire facility to have bad health services type income? Well, remember the cliff effect, that's possible. And then finally, as we've already talked about, might be possible to set up nursing services as a separate trader business and bill separately for those services. So just a reminder of how the facts can drive the analysis.
And another very similar example, Todd, you can walk us through it here, but maybe like the nursing home example, it seems helpful on its surface, but as you dive into the facts, maybe it's not quite as helpful as people had hoped.
Right. Yeah. So the surgical center, it's a very helpful example, but essentially the surgical center does not employ any of the physicians or nurses or medical assistants, but enters into agreements with directly with those professionals or their organizations to provide that medical care. Then the surgical center is only billing patients for the facility costs, not billing for those healthcare professional costs. Those bills will be coming from either the healthcare professionals themselves or from their related entities. And then similarly to what Max said, the surgical centers, they may be required by state law to house a certain number of nurses or medical staff. And like you said, that just might provide a little bit of risk and just be knowledgeable of that cliff effect.
Yeah, so I'd just say they're helpful examples in the sense that the IRS is at least acknowledging that a nursing home or surgical center could produce good income. It just is in the real world, likely no one is going to have facts as clean as the examples. And so what do? Well, you're back trying to figure out what's the significance if you employ nurses or doctors. Now, how much revenue are they generating towards the total business? Thinking about the cliff effect. A variety of things to think about there. So examples are helpful in a way, but then also maybe not as helpful the more you think about it. Maybe just real quick, Mac, if you just...
Yeah, people can go through the slide. The main point I wanted to make here is for folks in the banking business. There were some favorable items in the final regulations, just clarifying that certainly taking deposits, making loans is not a service business. There certainly banks, S corporation banks will need to, if they've got a trust department or wealth management division, will need to take a look at potentially breaking those out as a separate trader business, and a couple other points made on the slide, but I think we can keep on moving.
Well, I mentioned this, and okay, we're down to 2 minutes, so I'll move really quickly. But the crack and pack rules, just be careful. If you're a specified service trader business and your thought is, well, we're going to pull out, we have some component parts that we think generate good QBI, and we're going to restructure. Just want to be careful, because there's an anti-abuse rule that could prevent this. And one of the examples is a law firm that is bad income on its own, and it tries to pull out its real estate and pull out its admin services and try to argue those generate good income. There's an example that polices that and basically pulls it all back together and says, no, this is still a law firm business and it's still producing SSTB income. Just something to be aware of. Brings us to our third polling question, the definition of brokerage services. I think Mac talked upon this quickly. Arranging transactions between a buyer and seller with respect to securities for a commission or fee includes who? Excellent. So we'll move quickly here. I think we can get to the last polling question here with maybe a minute to spare. Compliance considerations, there's a whole bunch of additional tracking and reporting that's going on this year as people are sitting down to prepare their returns. One really important thing to recognize is if you fail to include any of the necessary information on a K-1, so if you fail to call something QBI, if you fail to include wages, if you fail to include UBIA, under the final regulations, that is presumed to be 0 for the recipient owner, no matter their individual profile. And this is actually a more relaxed rule. Under the proposed regulations, if you failed to include any of the necessary information, all of it was presumed to be 0. So final reg's a little more relaxed, but still, in all cases, you're going to want to include the information, because if you don't do it, the presumption is 0 at the individual level. 754, there's a question about whether 754 adjustments are when you buy into a partnership. You get a special basis adjustment in the partnership's property. There's a question about whether that basis adjustment is UBIA. UBIA is one of the limitation factors that's taken into account for 199A purposes. We won't go into this in too much detail, but in fact, yes, certain 754 adjustments do qualify as UBIA. It's not your total 754 adjustment. It's only going to be a portion of it, depending on the fact pattern, but fairly taxpayer-friendly rule. These following items, this wasn't pointed out in the proposed regulations, but it was in the final, that these items here reduce QBI, your SC tax deduction, your self-employed health insurance deduction, so forth. You know, there's a question about, did the proposed regulations really anticipate that these items would be taken into account and the final regulations just clarified it? Or is this a brand new rule for the final regulations? It's important because if you wanted to rely upon the proposed regulations, the question is, do you still have to do this? That's a bit of an open question, but something to think about. 2, UBIA to hold property and for it to count for UBIA purposes, you have to hold it at the end of the taxable year. The final regs confirm this. This means if you sell the property in December 1st, you cannot include any of the basis as part of your UBIA calculation. You can apportion W-2 wages, but you cannot apportion UBIA. Not a very taxpayer-friendly rule, but it's prescribed by the statute. It's not the IRS's fault. The IRS is just going by what Congress put in the statute. And this brings us to our 4th polling question. Property must be held in the last day of the taxable year in order for taxpayers to use UBIA. True or false? Excellent. True is indeed the answer. So there's questions waiting, and we'll address those questions here. We'll stick around, and if anyone is interested, they can stick around with us. We'll keep the webinar open. If there's additional questions, please pose them. So just wanted to say thank you to everyone out there in the audience, and a big thank you to Mac and Todd for helping out today. Very appreciated.
All right, we do have just a few questions. Do you guys want to stick around about 5 minutes?
No problem.
Okay, so the first one says, is triple net defined? What if you have 3 tenants and one tenant is a triple net? Is the whole building eligible for safe harbor?
Mac, I'll let if you've got any ideas, but I think, you know, potentially there you could, you know, potentially maybe, is that one trader business? Could you view that as multiple trader businesses? Or could you, maybe you could make the argument as well that it's a single trader business and not everything is on triple net. So maybe you're okay. It's an interesting question.
Yeah, it is, and I don't know that I can add much to that. I guess my first thought is, well, what's the ownership structure, and is it is it a rental real estate enterprise on a group basis? But you know, having the triple net lease would, on a very strict reading of the safe harbor, would seem to potentially kick it out of the safe harbor. Yet, likely because of the standard leases, would have good arguments that it's a trader business, I would think. So, you know, that's kind of where I'd start, I guess, with it.
I would agree. And Jim, if you're frustrated by that answer, then we are we are right there with you. It's just it's a huge murky area. Rental income specifically in 199A, it is just there are not a lot of clean answers, unfortunately. So it looks like the second question was, in terms of making a rental look like a trader business, is there anything else to do other than filing 1099s and keeping separate books and records? Well, I think, you know, you're going to want some time spent either by an owner or employee or a third party. That would be important. You know, the more time spent by someone sure makes it look like more like a trader business. You know, what else? I mean, all the normal things you would do outside of the rental space. I mean, if you can do that as part of your rental enterprise, and I think it makes it look more like a trader business. I don't know, anything I'm missing, Mac or Todd?
You know, I guess from my standpoint, Adam, you know, it'd be taking a look at all the facts. I mean, if the leases tend to be short term and you're spending time renegotiating leases on a regular basis and there are financing issues, some of those things that aren't necessarily qualifying for the safe harbor, but you know, versus say a 20-year lease that has CPI adjustments over the 20 years and it's on autopilot. I mean, there'd be a lot of factors that would go into looking at in addition to what was being done, I would think.
I agree.
For sure. Yeah, fully agree on that one. The only thing I would add would be just going through those qualifying services and seeing how many of those you can potentially layer into or look into hours-wise that might help your argument.
Yep.
So someone asked, is a medical spa hair salon? I don't think, I'd have to go back and read the proposed regulations, but I don't think that's an SSTB. I think that's carved out. Mac, I don't know if you remember in the proposed regulations. I don't think, I mean, it probably depends on what medical services are being provided, but I thought a typical spa may not be an SSTB.
Yeah, I'd want to take a look at that definition under health services, but I believe they were carved out.
So it may not matter if your taxable income is below the, you know, above or below, it may not matter. You know, if there were the medical spa, if you had some medical services being performed, maybe then you'd have to pay attention and taxable income would matter, but hopefully you could just argue that you're not an SSTB in the first place.
So just quoting from the regs here, I did a quick search. It says, for example, the performance of services in the field of health does not include the operation of health clubs or health spas that provide physical exercise or conditioning to their customers. Yep. So anyway, if that's of any help or use.
Nope, that's great.
So then our last question is, if you have a strip center, like a strip mall, I'm assuming, triple net leases, but the landlord contracts for the maintenance and pays for the taxes, insurance, etc., even though the tenant pays a portion of CAM fees, you know, is this QBI? Well, so I see you're triple net lease, so I guess that's one check mark maybe against being QBI, but I guess again it would go back to all the factors we talked about. That is this being treated as a trader, but forgetting the economics of the lease, but are there books and records? Do you have a separate bank account? How much time is spent? All those things I think would go into play to try to make a determination of whether generating QBI or whether it's not QBI.
Yeah, I could see a difference. I mean, we talked about potentially restructuring leases, and so I would take that as an example and say, well, if we went in and renegotiated leases, increased the rent, and then the landlord took on maintenance and paying taxes and so forth, that would be the sort of thing that would be a step towards supporting a trader business determination. Well, then is that any different than in this case where the tenants are paying rent plus a common area maintenance fee that covers the taxes, insurance, and maintenance, most likely, but then the landlord is going to show those maintenance items on his or her tax return as a deduction. So on the one hand, I kind of look at it and say, well, if it's triple net lease, that looks like that's a hurdle. On the other hand, how is this any really different than just grossing up your rents? And aren't we in substance the same? And so I think it comes back to all the other factors and making that evaluation of whether is this truly a triple net lease or not.
I agree. So it looks like that's our last question. Nothing else will go, but again, for those of you that stuck with us through the webinar and the Q&A, we appreciate your attendance and appreciate your questions.
Awesome. Thank you all so much. Have a great day.
Thank you.
Bye.